Welcome to this explainer. Look, if you've been tracking the markets lately, you know we just witnessed an absolute roller coaster in precious metals in mid-May 2026. So today, we're bringing a sharp, analytical lens to this sudden and dramatic volatility to break down exactly what happened behind the scenes.
We've got to start by asking the most pressing question on investors' minds right now following the highly anticipated Trump-Xi Beijing Summit. Why did silver, a metal that was just riding a historic high, suddenly crash by 10%?
Well, the answer lies in a massive unwinding of expectations. This was really highlighted by a brutal 7.7% single-session drop in spot silver, down to $77.11. Literally, in the blink of an eye, a massive, multi-day pre-summit rally was completely erased. Here is our roadmap for today. We'll start with the post-summit crash, contrast silver's two demand engines, detail the China trade connection, and finally, zoom out to the macro-monetary picture and the reality of 6 years of structural deficits.
Section 1. The Post-Summit Silver Crash.
Let's look at how this played out. Starting around May 11th, the market aggressively priced in a trade breakthrough. We saw a 7% premium buildup, pushing prices over $85. By mid-summit, optimism peaked around 87. But when the summit wrapped up with just a loose strategic stability framework rather than a formal tariff extension, that big breakthrough just never arrived. The result was a violent unwinding that sent the price crashing back down to $76.30.
Looking at the hard data across the US COMEX exchange and India's multi-commodity exchange, the divergence is pretty striking. US silver futures plummeted over 10.5%, which is way harder than gold's 3% drop. Over in India, this wiped out more than 20,000 rupees per kilo. But the fact that gold held relatively firm, that tells us this wasn't just some broad market sell-off. There's a specific silver story here.
Section 2. Silver's two demand engines. To really get why silver reacted with such extreme volatility, we have to contrast it with gold. 95% of gold demand is purely monetary. It's the ultimate safe haven asset for central banks. Silver, on the other hand, puts on a hard hat. It has a massive 60% industrial demand base. That makes it incredibly sensitive to manufacturing expectations. When global trade relations look solid, factories plan to build more, and they need more silver.
And that 60% industrial chunk isn't just basic manufacturing. It is completely tied to the green transition. We're talking solar panels, electric vehicles, and this is huge right now, the massive semiconductors required for AI data centers. These are sectors that simply cannot function without uninterrupted global supply chains.
Section 3. The China Trade Connection. So, how does this tie into Beijing? It all comes down to what traders call the summit premium. That recent price spike from $77 up to over $86 was built entirely on a speculative bet. Traders were basically anticipating that a normalization of trade relations would trigger an immediate wave of delayed industrial silver procurement by solar and tech manufacturers. They were buying the rumor of a formal US-China trade truce extension.
Because here is the ultimate bottleneck. China controls roughly 85% of global rare earth processing. Think about that scale. If restrictions ease, tech manufacturing booms. But without a formal signed trade truce, manufacturers are left facing immense supply chain risks. That uncertainty forces them to keep their forward silver orders completely on ice.
To sum it all up, roughly $8 an ounce of silver's recent price was purely trade optimism. Optimism that evaporated overnight. When Trump and Xi only agreed to a vague framework rather than a hard rare earth truce, the industrial market repriced instantly. The bet failed, and the money vanished.
Section 4. The macro-monetary picture. Now zoom out from the geopolitical noise for a second, because the broader macro headwinds decided to show up during this exact same week. Just look at the April 2026 inflation numbers. Consumer inflation hit 3.8%, and wholesale producer inflation surged to a massive 6.0%, the highest in nearly 4 years. This pushed the 10-year Treasury yield over 4.5%, which suddenly makes non-yielding assets like silver far less attractive to institutional cash.
Add to that the transition to our new Federal Reserve Chair, Kevin Warsh. Warsh is inheriting a highly restrictive inflation climate, which is being supercharged by geopolitical shocks like the ongoing Iran war and the squeeze on the Strait of Hormuz. Because of these incredibly hot inflation prints, markets are totally fading their hopes for imminent rate cuts. Instead, they're pricing in a prolonged period of restrictive monetary policy.
Section 5. 6 years of deficits.
But look, despite this really painful short-term correction, the structural realities underneath it all, they are rock solid. We are currently sitting in our 6th consecutive year of an annual supply deficit, staring down a projected 46.3 million ounce shortfall for 2026. Mine supply is barely growing at 1%. COMEX registered inventories are critically low, and those same geopolitical energy costs from the Iran conflict are adding $40 to $50 per ounce just to pull the metal out of the ground. These constraints create an absolutely massive long-term price floor.
If you want to understand the current value, you have to look at the silver to Dow ratio. At the 1980 peak, it was roughly 18. During the 2020 COVID crash, it blew out to an extreme of 1580. Today, it sits at 659. What this proves is that we are still in a massive, long-cycle compression. Physical metals are incredibly undervalued compared to these heavily concentrated stock markets.
And we see a similar story with the gold to silver ratio, which is currently sitting near 59.5 to 1. Considering the 20th century historical average is closer to somewhere around 47 to 50, this tells us that while silver definitely took a beating this week, it has significant room to snap back to its historical averages the second that industrial demand reawakens.
Which leaves us with a critical thought to wrap up today. The short-term premium is gone, yes, but the physical reality remains. As these undeniable industrial supply deficits continue to collide with geopolitical deadlocks, how long can short-term pessimism suppress an actual physical global metal shortage? Will silver's structural floor ultimately shatter its monetary ceiling? Thank you so much for joining me for this explainer. Stay sharp and keep your eyes on the data.